international wealth management at Nomura, joining us live. Gareth, great to see you and appreciate your time. Got to start first with this very sharp change in the Fed narrative, right? And, with Wall Street where it is right now, the way it's valued, the levels it's at, the Fed put looks like just got taken away and just got cut off at the knees.
Well, Martin, as previous speaker spoke about the policy meeting advent calendar, I think that's a great description. But to be honest, the checklist and the advent calendar haven't been that tasty. Even the Fed coming out, this wasn't a major surprise in the sense that we knew there would be one rate cut. We know that they want to keep the optionality, given that they have Trump with potentially inflationary policy coming out early Jan. The inflation number which coming out today should be pretty solid. Labor market remains strong. The consumer is strong. The equity market is strong. The U.S. is actually in a good position compared to other places like Europe. So it can sit and hold on. The idea that they may hike, I think that's just building in, optionality that if the inflationary policy that could happen post the Trump coming in January does materialize, then they have that option. They're kind of forewarning the market. But, our house view, the market's house view is still for 2 rate cuts next year. A much more buy and hold, let's see what happens, than the more reactive policy than a proactive. So I think this will still watch out. I think it will still be constructive for equity markets. Yields, though, will probably tend to grind higher.
Gareth, listen, I don't mean to be, like the Grinch, right? But why 2? Why are you sticking with 2 for 2025 when markets are expecting, probably going to have to wait until summer sometime, mid-year, right, to get even a first 25 basis point cut, another one. And for the full year, I don't think anybody's expecting anything more. They're only expecting about 1 and a bit, not even 2.
Yeah, well, this has changed. We had more, and as the market and the color evolves, we still think that without the inflationary policy that Trump's going to bring in, and there's still questions on how we can implement these, there still should be a deflationary environment. You still should see inflation slowly coming down. Even this latest print, while it will be solid and sticky, we still think the trajectory is for a bit more deflationary from here. So in that environment, over the whole of 2025, we see 2 rate cuts, a lot less than the 5 that most of the market had beforehand. This could change depending on how we see policy enact. But as the Fed is doing, they are pausing. They are waiting to see what's going to happen. And that is, I suppose, creating some stability in the market. They're not saying hike. There hasn't been any word of hike from the central banks. There is just a pause and wait to see where it goes. And given the strong sentiment at the moment, given the conditions are still pretty easy for the U.S. economy, this should be status quo for most of the asset classes in the U.S., except for, I suppose, long end of the yields, which are now pricing in a bit more risk there. And we're seeing that term premium come in. And that's actually good for bond markets. We've got the steepest curve we've had for some time, suggesting that you're starting to get paid for taking longer duration.